Chapter 7 handout. Hopefully we'll finish it today. Let's go ahead and get started. And we've gone up through the overview, I guess. Okay. One of the things on the CPA exam they like to talk about is the control environment. And we remember those by I.C. Hambo. I.C. Hambo. Integrity is of management. Probably the most important one of all those. Commitment to competence. That they have a commitment made to internal controls. Human resource, hiring, firing people, all that kind of stuff. Assignment of authority. How is authority assigned? And one of the worst things is a lot of times they don't assign authority. I had a case where we caught people committing a fraud, and the supervisor said, is this on me? Because he had no idea. Like, well, am I responsible for it? And it was never spelled out. There was nothing that spelled out who is responsible for detecting fraud and all that kind of stuff. So assigning responsibility is huge. I had another one where a guy was accounting, and they were supposed to be, that's kind of long, but when you import something, you pay a tariff on it. It comes in, let's say you pay a tariff of, I'm making this up, $50. When you send it back out, if you export it, you can reclaim that tariff, and that's done by the accounting department. And I remember bringing this up, and the guy in the accounting department just vehemently denying that he had responsibility for it, even though it was right there. And it doesn't matter what it says there. I don't have responsibility for that. And it's like, yeah, you do. But anyway, management's philosophy style. A lot of times, a very aggressive management may try to get away with not using the controls. Board of directors and the organizational structure, especially if it is decentralized, it tends to be a little bit more difficult to control, internal controls. Okay. So that's the environment, and here are the activities for it. Physical controls. Locked doors. Anything that prevents people from actually physically getting into the where they're not supposed to. For instance, at a bank, the vault. There's very few people that should be able to get into the vault. It's locked, and the whole idea of a vault is that you have things in there you don't want people getting access to. So that would be an example of a physical control. This one is a little bit odd. This is the new one, and I'll tell you why this one's odd. What am I missing? Oh, you. Authorization policies and computer controls. These are to make sure people are only authorized or are authorized to do it. I'll tell you why this is weird. It is new. It is included in those. We used to remember it by pips. Now it's pappies. I don't know. Anyway, it's a little bit odd because if you go down here to segregation of duties, I'm going to jump ahead a little bit. And remember the segregation of duties, remember by car. The second one's authorizations. And the third one is record keeping. So we've gone through that one before, but remember by car. But yeah, it also has authorizations in there. So that's why I said it's a little bit strange. The differences could be that the authorization for individual transactions, whereas this is authorizations as a role. For instance, accounting as a role of authorizations for record keeping, but actually when you're actually doing the journal entries themselves, that is actually the record keeping, the act of it rather than the authority. Performance reviews. Now this is not employee reviews usually. This is usually budgeting. And it sounds kind of weak, like, oh, that's not a very good control. But actually budgeting is one of the best ones. And here's why. If there is a material misstatement, firstly, everything in a company is budgeted. Everyone has a budget. We don't record it. Actually, governmental accounting does record it, but in regular accounting, we don't record the budget. But the budgeting is actually a very important control, because if there's something that material happens, it's probably going to hit somebody's budget. So the performance review, especially things like budgeting, one of the other ones that is very important is the capital budget. These are important because a lot of times these will find, especially things like errors. If it's a fraud, it's going to be difficult to find it, but because they're going to be expecting it to show up in their performance reviews. But if it's an error, the budgeting a lot of times will catch it, because someone will catch it and say, "Hey, how come my budget's getting hit by this?" Capital budget. This is for acquisition of assets, long-term assets. And generally speaking, you don't just buy long-term assets on a whim. There's usually a lot of planning that goes into it. And the thing is, if you do find things that were added that were not on the capital budget, if you find long-term equipment, things like that were added that were not on the capital budget, that raises a little bit of a flag, in that you have to go see why they did it. Was it as it's purported to be, and why was it included? Because usually there's planning, capital budget. Okay, we're going to add this line, assembly line. We're going to need, this many more machine. Speaking this stuff up, but you understand that capital budgeting is usually a fairly extensive process, and that you work out the numbers to see if it's going to be able to cover the cost of machines and all that kind of stuff. So anything that gets added, any long-term assets, say, they should be on the capital budget, and you can go to look in the capital budget to see which ones, what ones are slated to be implemented, and then go look for those too. So there is a budgeting control, and capital budget's a big one, but department budgets too. Yeah. Okay, information processing. This usually comes in two flavors. It's back in my day was completely new, but nowadays everybody knows it. And that is usually there is an operating system that will need to be password protected. We'll have applications that are password protected. I'm going to stop on those two for 1 second. So in any computer system, there's usually two levels of authorization. There's one level just to turn on the computer to get into the operating system, like Windows or Apple or whatever the operating system is, iOS or whatever operating system you're running on, Linux. So there's actually two logons. There's logons to get on the computer, just so that you can actually get on the computer, but then also the applications. If I'm in the accounting department, I should not have access to the production application or the human resource application or the finance, or there's certain things I shouldn't have access to. There's no reason for me to have access to them. So one is just to get on the system, and the second one is the different applications that you'll have different authorizations to get into those different applications. So the other thing about these information is a lot of times you'll have operational embedded. Okay, spelled that wrong. Operational checks embedded into the system. So you may have limits on amounts. Oops. You may have rational inputs, like negative inventory, for instance, is not. So you may have any number of different things that you'll check for. So limits on amounts you put in, rational inputs, negative inventory, duplicates. It might spit out saying, "Hey, you already paid that invoice. Don't pay it twice." So these are all things that can also be built into the process, and these are also controls. So limitations on amount. So if I type in $5 million for a stapler, it kicks it out and says, no, that's not rational. If I put in, I just purchased negative 500, toys or whatever, it'll say, no, you can't have negative toys. Purchase. Oops. If I forget to put the letter L in for duplicates, it'll kick out and say, you get. Okay. Segregation of duties, we already covered this. We're not going to go over it again. It is part of those. The activities, but and again, the kind of weird one there is the authorization, which is actually doubled up. Okay, I think we talked about this too. We talked about this in we talked about this in evidence. Inquiring is simply asking people. How is this done? How's that done? Inspection of documents and reports. And this is normally what we think of. This is also not it is not, these are things that are not done by the auditors. So asking how they did it, inspecting, you're actually looking at the work of the client. Observation, this is more persuasive. This is when you actually do it yourself. Oh. Missed that one by a mile. And tracing, again, this is also more persuasive because the audit, let me do this differently. More persuasive because it's the auditor's own work. And the same thing down here. You know, you're not taking somebody else's word for it or looking at a document that they made. These first two come from the client. Inquiry, inspection come from the client. They are evidence, but a better one is the observation, because that's when you are doing it. It's more immediate as far as there's nothing in between. There's no filter. Seeing how they do it and tracing. And I know I've told you this before. On audits, I can't tell you how many times I've asked people how they do something, and they tell me, and I go, it is completely different. Okay, documenting your understanding of internal control. So you are required to get an understanding of internal control. It's required. So one of the things you have to do is document how you got it. How'd you come across this understanding of internal control? And there's 3 ways to do it. The first way is the internal control questionnaire. Well, that's numero uno. Second one is a flow chart. And the third one is a written narrative. So this is how you document your understanding of internal control. I want to warn you about, I'm misspelling everything today. I have seen in accounting books where they say that you can use the client's policies and procedures as documenting internal control. You cannot. That is not recognized by the AICPA. So I'm telling you this because you ever see it in another textbook, and I have seen auditing textbooks that show it this way, that looking at their policies and procedures. The policies and procedures may not be being followed. And that is passive. That's something that's made by the client. It is not one of those things that the auditor has actually seen for themselves or work that the auditor has done for themselves. So the policies and procedures by the client are not ways to document it. You know, some textbooks will show that. According to the AICPA, anyways. And they make the CPA exam, so let's go with that. Okay, internal control questionnaires. These are a yes/no example, similar to like the Tesla controls. They are yes/no. And usually, yes means good. and no means bad. So I talk to my dogs. Oh, don't be bad. Ollie, quit biting him. Okay. So yes, you're good. So for instance, here's a list for payroll. Are all employees paid by check or direct deposit? Yes or no? You don't want people being paid by cash. Is a special payroll bank account used? Yes or no? Are payroll checks signed by? Okay, you get the idea. We're not gonna go through all these, but generally speaking, they have yes or no, and what they will do is a yes means everything's okay, and a no means it's not okay. So here's the internal control questionnaire, and yes means everything's okay, no means everything is not okay. All right, there is a little bit of a problem with the internal control questionnaire. And the problem comes from the people that you're going to be facing when you're doing this internal control questionnaire. They oftentimes will have already come out of public accounting. They know the trick. And even though you have a sparkling personality, they got a bunch of work to do and they don't really want to talk to you very long and they want to get rid of you. Not because they don't like you, it's just because they got a bunch of work to do. And, so anyway, you come in with your internal control questionnaire and they know that if they say yes, that everything's okay. So as you go through the list, they say yes, 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 no, really, just kidding, yes. You go through the list and they know the program, and they know that to get rid of you if they say yes, that you're going to walk away. So that is a problem with internal control questionnaire. So what a lot of times they'll do is that there'll be certain questions, like questions number 8, question number 10, question number 22 will be, the best answer will be no. And a lot of times it'll go with a different one. So number 3 and number 8 will be the same question, except one will have the correct answer as yes, one will have the correct answer as no. And you compare those two and see if they're actually listening or if they're being truthful with you about what the various controls of the company. So a lot of times you'll have a few set up that if they do say no, that is the answer you're looking for. And this is how the questionnaire is made up. Okay, good thing about a questionnaire. Good thing about questionnaires, anyone can do it. Your first day on the job, they can hand you the questionnaire and say, hey, there's the assistant controller. Go ask the assistant controller these 3 pages of questions and bring it back, and we'll go over what we need to look at. So anyone can do it. You can, if you have an internal control questionnaire, and it's very, kind of like what we just saw on the screen there, it's very complete. It isn't like you're going to miss something. These have been made over years, and they're honed in usually by by what's important. All the bases are covered here. All the controls that should be there are there, and anyone can do it. The drawback is that whoever you're asking this to probably already knows the program and answer accordingly. Okay, flowchart. Flowchart is a visual. It's a visual explanation. What's the word for it? What is this? Visual something of the internal control. Okay, who's better than me? Some of you guys are better than me yet. This is a visual blank of internal control. I don't know, let's say diagram. If I come up with a better word, I'll put it in. Okay, kind of a visual diagram, a visual explanation, or however you want to put it, of internal control. And it'll show where the stuff comes in, what it goes to, where these are. All these little things mean something. The little squirmy thing here means it's a document. This, is that a trapezoid? Maybe not. I don't know. Anyway, it is it's a process. Some of these are saving, filed. So it's a visual overview of the internal control. That's it. Overview. So a visual overview of internal control. And if you're used to working with flowcharts, they're a little bit, it takes a little bit of time to get used to, but once you get used to using them, they actually are fairly quick. You can fairly quickly see where the problems are on these. There's a problem with the flowchart though. The problem with the flowchart is if you take that flowchart and you show it to somebody in operations, it's not going to mean anything to them. So you show them the flowchart. Is this right? What is this? Why'd you do this? They're not going to be. So if you're used to using flowcharts, they're great for documenting it. If you're not, but it's very hard for people who are not familiar with flowcharts to have them look at it and to get any kind of feedback. So flowcharts are, they take some time to get used to doing. Once you get used to it, they are actually fairly quick, but they are also difficult sometimes in that you can't just simply ask somebody, is this okay? And expect them to understand it. Okay. Written narrative is exactly what it says. You just write up their control activities. Bank reconciliation. Senior accountant and accounting manager perform all the bank reconciliations, review the cash, blah, 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 blah. Okay, and so this is a written narrative of what happens for the reconciliations. Now, the good thing about written narratives, anyone can look at it. You can take a written narrative and bring it to somebody who has no idea about internal controls. They've been working there for a while, but they don't know the internal controls. You show them this written narrative, you say, is this right? And they'll say, yeah, that's right. Well, actually, this part right here, sometimes we do that, but sometimes we also do this. And they'll give you a little more insight into it. Oh, okay. So if it's like this, then it goes like that. Yeah, okay. So then you add that into the narrative, and you keep going around with that until you get a very accurate document. So the beauty of that one is that anyone can read it. Anyone can understand it. You can hand it to anybody, they'll know what you're talking about. The downside is it takes a lot of time. And when I was doing internal auditing, we had a lot more time than the external auditors. So what I would do is start out with a written narrative, and I would do that because I could show it to a number of different people, and they could all say, "Well, this is we don't really do it like this," or yeah, that's exactly how we do it. Whatever. You could really get a really perfect document. From there, I would make a flow chart. So I would actually document the internal controls two different ways. One would be the written narrative, because I get very accurate. And then once I got that very accurate, then I would do the flow chart. And I remember I was inventory guy in auditing. God knows why, but anyway, I always got stuck with not stuck, but that was my specialty, inventory. So, and I remember I had written up and done the flow charts for the inventory. I had, again, lots of times, the external auditors came in who've been doing the audit for years. And what they had was fun, but you could tell there was like big gaps in their flow chart because they didn't know the nuances. And simply because they didn't have enough time to go through and know. And so I remember them being like, oh, can we take this? Like, yeah, take all of it, But whatever you guys can use, it's fine with me. But I remember that theirs was, it was pretty good. I mean, it wasn't terrible or anything like that, but there was a few things that were missing. Simply because they don't have enough time. I'm doing an inventory, and I'll be doing it for 8 weeks. They come in and they may have 3 days to do it. They take a physical inventory one day, and then they have a couple days to wrap it up. So, time. Okay. Risk assessment. this is one of those things that is often it's become more popular, but more it's always been there, but it's become more studied, and that is oops, the risk assessment at the assertion level, and this is what we're normally used to seeing. What are the risks of inventory? What are the risks of something being misplaced, something not getting into the system, of something being counted twice in the system, all that kind of stuff. So these are the normal kind of things we think of usually for as far as at the assertion level of, well, like up here, control environment, the occurrence, completeness, all those kinds of things. That's the assertion level. And those are the things that we normally, when we think about risk assessment, those are kind of what we focus in on. That's kind of what we do the testing on. However, there are stuff that's at the financial statement level. Management incompetence. It's not that they're evil, but they may not have all the experience that they need, or that they maybe especially if you have a company that's growing quickly. You may have a company that has 10 people in it, and they're successful over time. As things ramp up, those people generally, oftentimes, will still be thinking they're a company of 10 people when actually now they got 800 people, and the controls are different. The controls mature with the company, and they may not be up to speed on them. So when we say incompetence, we don't really necessarily mean that they're bumbling idiots, but a lot of times it's that they are ignorant sometimes of what they should be doing because they're used to a different size company. For oversight by the board of directors that are simply rubber stamps. I worked when I was going through college. I worked in a bank that we had the bank was pretty much owned by one very wealthy person owned most of the bank, and he would send his wife to. She was on the board of directors, and his wife would be on the board of directors. And I remember I had no idea what my future was going to be in accounting, but the maintenance people were actually there to see if they had like all this water and catering and all this kind of stuff, make sure the lights are working and all that. So we were kind of there while they're setting up. And I remember that no one took it seriously, because the woman, she was very nice, very sweet. She'd always come up to us and talk to us. We're the maintenance people. We're there to make sure the lights are working and that all this stuff, the viewers and all that are working. And she would talk to us and laugh, and then we'd leave, and literally like 15 minutes later, everyone would leave, and I don't know what they talked about, but it didn't seem very much like an oversight kind of a situation. All right, declining economic conditions, economy's going bad, or in their specific market. Bankruptcy makes a company more risky because they have more to them, cooking the books is more of a pressing concern than a company that's doing well, because they may be cooking the books not because they're evil, but because they are trying to get a loan or something to keep the company going. One of the biggest things is a domineering executive. I'm going to put something else in here, or aggressive management. I'll put this separately, I guess. Two T's in there. A domineering executive or aggressive management. These are a big problem because what you'll oftentimes have is management override. And management overrides when they override the controls. So a domineering executive or aggressive management. Okay. Test of controls, we talked about this a little bit. Plan the test of controls, these are those yes-no tests. I know some of you turned in the sampling exam. I'll get those on Friday. So plan the test controls, yes, no. Perform the test of controls. So plan them, perform them. And evaluate the control risk. And there's a design deficiency. And there is an operational deficiency. A design deficiency is when the control is designed wrong. I worked on an audit where it was actually an insurance company that was owned by Navistar. And they had a reconciliation of their policies. And they had this reconciliation that was supposed to tie back to, reconcile all the policies that are issued with the accounting for them, the books, to make sure that, okay, if you have all this, these are the policies and the risks involved and the liabilities and all that, and to tie those liabilities out to the financial statements. An insurance company basically has a whole bunch of liabilities. People are going to crash cars and stuff. If you're insuring a bunch of people every day, someone's going to crash a car. That's a liability. On the other hand, you had a bunch of assets. So that's kind of like insurance companies: huge liabilities, huge assets. And so for these insurance policies, it was like to reconcile the written policies with what we actually had on for the liabilities. They had developed it, the reconciliation, kind of a strange way that actually what they're reconciling it with was the same report. The report that it wasn't going to the books, the report that was separate from the books was being reconciled to itself, basically. And as you can imagine, everything else came out perfect because it's reconciling it to itself. But again, that's a design problem. It's not anyone working, it's not the people who actually were running the reconciliation. The design of the reconciliation is incorrect. Now, it is possible, though, that people do the operational efficiency, the actual operations of it. People working the controls. Are not effective. It could be because they don't want to, it could be because they don't know, it could be it slipped their mind. It could be all kinds of things that it's not effective. So it's designed properly, but the people actually working it, those internal controls, the operational people, are not doing what they're supposed to be doing. It could be they don't understand it. And I've run into that quite a bit. Okay, I think we may have done this already. Is anyone awake? I know I've been babbling for 40 minutes. If anyone out there is listening, maybe let's do page number 5 and see which ones are, which transaction will you have the lowest risk. I think we did this before. Lowest risk, routine transactions. Less, everyone knows how to do the transaction, and there's less to go wrong. Non-routine and estimation ones, you could have different things pop up. Auditor perform test and controls for all the following except, this one's a little bit tricky. Okay, so what do we want internal controls to do? To detect material misstatements, that's a good one. We want them to prevent material misstatements, that's even better. We want them to be effective. The one that we generally don't test is the efficiency. So if they're inefficient, okay, we are not as interested in it being efficient as we are as it being effective. Maybe they have 2 people doing a control that could be done with 1 person. Okay, it's not efficient. But if the control is working, we're happy with it, even if it is an inefficient control. So that's the except. Which following procedures would be the least useful for evaluating the effectiveness of the client's internal controls? The ones that would be least effective, B would certainly. And performance of the controls, that's the best evidence. Inspection of documents, this one would be not as good. Yeah, I tell you what, let me do this. Reports of employees, let's say medium. Reperformance and observation, those are the best. The auditors are doing them themselves. We trust ourselves more than other people. Maybe it's a character flaw, but regardless, reperformance and observation, those are things the auditors are going to do themselves. That's the best evidence. Asking people about it, looking at the documents they made, that's also good. Things like the internal control procedures manual may not have anything to do with what's going on with the company. And a lot of times these will just simply be a book on a shelf or in a PDF somewhere that no one ever looks at. And, this is not usually something that is oftentimes it's not kept up to date. My experience has not been kept up to date, but also that at any given point in time, things may change, and they may, the lag in putting it into the procedures might be a year or so. So it's definitely the worst one of those. Testing controls allow the auditor to complete all the following except. Well, you can't rely solely on internal controls. You have to do substantive testing. Must substantive. There's other ones though that you actually you can use it for it. Effect of entity size and internal controls. Smaller clients will usually have weaker internal controls. Smaller clients may not have enough people to properly segregate duties. Yeah, if you only have two people working in the office, if you only have two people working in the office, how are you going to segregate duties? You have three separate duties for any type of transaction. If you only have two people working in the office, you can't divide that up three ways. Okay, so what do you do as an auditor? For a smaller business. Um, Hopefully, the owner is involved in the daily operations. Uh, and if the owner is involved in daily operations, the idea is that the owner would be in their best interest to keep tabs on everything. So the owner should be able to keep tabs on all the different things that are happening. Now, the owner is not unbiased, but this allows the auditors to focus their audit on the owner. So you get the owner's bank accounts and all that kind of stuff, see what money goes in and see where they got that money from, see what comes from the business to tie that out to the net income and all that sort of thing. So the nice thing about a small business is, the owners are actually working it. So there's a bakery, the owner's out there every day, they have the money coming in, the loading of the trucks, all this stuff. It's in their greedy best interest to keep control of that. Assuming that's happening, then the auditors can focus simply on the owner rather than trying to look at controls that don't exist. And that is one of the things about auditing that is difficult, because you're required to get an understanding of internal controls, and some of these small places, they don't have it. They simply don't have internal controls, so they don't have enough people, for one thing. So that is one of the kind of quirky things about auditing, is that smaller companies a lot of times are a little more difficult because of the size. Okay, let's stop here. Let's take a break. And let's say be back at, be back at 3 o'clock. Okay, limitations of internal control. So there are some things that internal control is sort of helpless when it comes to. And these are the limitations of it. And so it doesn't matter how well you have the control designed, there are certain things that can foil it. Okay, first one. Let's try that again. Mistakes by employees using the controls. I think I already told you this boring story, but I'll tell it to you again because I have no pride. But my first job was working in a bicycle shop, and they had us working at these cash registers. And these cash registers were, we didn't know how cash registers work. And these cash registers were kind of old, and you print up a receipt, and they wouldn't always print up correctly. So you go over and ring it up on a different cash register. They had a better, had the ink was better or whatever. And so you had transactions that were being double counted in that. And after a couple of weeks, me and there was two other kids. We were 14. I don't know if I don't know if you can even work when you're 14 anymore. But anyway, they had these 14-year-olds. And they had us working in the cash registers. We had no idea how cash registers worked. And they said, "Okay, we're missing a whole bunch of money." And one of the managers though looked at the printouts and says, "Well, wait a minute. How come there's items that are being printed, that are being rung up within 30 seconds of each other on 2 or even 3 registers?" And we're like, "Well, sometimes that register doesn't work, and so we use this one." You can't do that. Well, here's the limitation of internal control. We didn't know what we were doing. We didn't know how the controls worked. During that period of time, someone could have been sitting from the cash register. No one would have known because it was a mess. The internal controls didn't work because of us. Actually, you should not put write this down. Don't put 14-year-olds in charge of the cash register. But anyway, mistakes by employees. Doesn't matter how the cash registers were working fine. There's nothing wrong with the cash registers, but the employees. The next one used to be included in number 1, but they broke it out separately now, and that is errors in programming. So that is when the controls are designed fine, but the programming isn't what it should be. Management override. For instance, the president Okay, so the president tells the accountant to make a fraudulent journal entry. So that would be an example of a management override. Now, this is one of those things. It doesn't matter how well the controls are. So if you're an accountant, you could be wrapped up in this. So make this journal entry. You go, where's the backup? Where's the documentation for it? There isn't any. Just make the journal entry. Don't worry, we're going to cover it later or whatever. Management overriding the controls doesn't matter what the controls are. The controls might be that it has to come in through the sales register before it goes on the books, but if some of the upper management comes in and says, "Forget about that, just do this," That's a problem. And by the way, almost all fraud, many frauds are caused by this. Pretty most. I should say most financial statement frauds. Management comes in and says, do this. And by the way, one of the things, whenever a fraud, they find a fraud, people say, well, how can we make sure this never happens again? How can we make sure that this never happens again? You really can't. It's a limitation of it. There's nothing you can design that's going to keep management from coming in and saying, here, we got to do this. We got to make this journal entry. You either make this journal entry or clean out your desk, that sort of thing. So it's one of those things that really cannot be. And by the way, fraud's a crime. If you want to start eliminating fraud or a crime, let's start with murder and rape and all those terrible things that start with those first. Saying, well, let's make it illegal. It already is illegal. That's making murder legal doesn't mean it never happens. So it's a limitation of the internal controls, even if the controls are good, that management overrides them. All right, collusion. Two others in there. Collusion of employees So employees get together and collude to foil the controls. It's a limitation. It doesn't matter how well you have those controls set up. It doesn't matter how well the duties are segregated. If two people get together, they can cause problems. Okay, a client associate. A client's associate treasury director. This is a position. And a staff accountant colluded to embezzle thousands of dollars from the client. How could this situation have been avoided? The situation cannot be avoided with internal controls. Lie detector tests, first of all, they don't work, but second of all, a lot of times you can't. A lot of states prohibit them because they don't work. Prohibit Treasury Department employees from accessing cash. Well, that's their job. They must be able to access cash, or else you won't get bills paid. Install cameras in the work areas. This may not be taking place in the work areas. A lot of times collusion does not take place in the work areas. They do it specifically away from the work areas. So this is usually a situation that cannot be, it's a limitation. There's not, and I know people don't like that, but there's not a lot you can, hey, what happened? There's not a lot you can do with it if you have these things happening. Mistakes, errors in programming, management override, this is usually financial statement. Collusion, this could also be embezzling and employee theft. Okay. I'm going to go through these and then I'm going to clean them up a little bit. Material deficiencies. They get reported to management. And the audit committee. Significant control deficiencies. So, and these are less than same thing, and we'll talk about why in a second. Less than significant. Oh, these are written. Usually these are only given to management. They can be written, they can also be oral, depending on how significant they are. They're all insignificant, but if depending on what they are, but you report those, man, you're not going to bother the audit committee with, you know, the coffee fund is $2 short or something. Okay, now here's where it gets a little bit definition-y. The actual rules on it are for significant control deficiencies. They generally don't say material deficiencies in internal control. They say if it's significant. Now, by definition, if it's material, that's even worse. Material deficiency is a significant deficiency. So you'll often see this called significant deficiency, but that also covers material deficiencies. And it's because significant is to a lesser extent than material. So if something is material by definition, it's also significant. Let me write that down. So material and control deficiency is by definition also a significant one because it's significant. So if they say that there's something that applies to a significant control deficiency, it also applies to a material one. A material is more serious. So a material deficiency is also significant. So anything that applies to significant deficiencies also applies to material deficiencies. Question on that? Okay, I'm gonna put one more thing in here. For financial audits, scratch it. Internal control deficiencies are not included in the audit report. Why? There's two reasons why. First one is internal control deficiency may not result in materially misstated financial statements. Let me clean this up a little bit. Material internal control deficiency. May not result in a materially misstated financial statements. So even though we have this problem, it doesn't necessarily mean the financial statements are wrong. Yeah, it could be a problem. Let's say that let's say it's a jewelry store and they leave the front door unlocked at night. So, one of the internal controls would be to lock the door when the last employee out locks the door for a jewelry store at night. They're not locking it. Doesn't necessarily mean the financial statements are wrong. Nothing may have happened, but it is a control, a deficiency, and probably a material control deficiency. However, the financial statements might be perfectly fine. So a control deficiency, even if it's material, does not necessarily mean the financial statements are misstated. Second of all, let's go back to this door thing. You don't want to tell everybody in the world that there's this control deficiency, that the front door is open at night. Whereas if you have it on this audit report, it gets passed around, someone say, really? The door's open at night? And then, people showing up at night, going through the place. So, okay, so these are not included in the audit report. So financial statements might be fine, and second of all, we don't want to tell everybody in the world about their financial weaknesses. Okay. I'm done with this thing. Okay, we should finish this today. Yay. Okay, substantive testing. So internal controls, we do get an understanding of them, and we do testing on so we can rely on them. And the detection risk is a risk that auditors fail to detect material misstatement on the client side. This is the only risk that the auditors have control over. So detection risk, this is the only thing that we can control. How well we do our audit. The detection risk is the only thing we control. Okay, the auditor is has a client that is having financial difficulties. Which level of detection risk would the auditor likely to obtain reasonable assurance? Okay, we want it to be low. Maybe the 99% level. Yeah. So something that's more risky. High risk means we want low detection risk. In other words, the detection risk, the risk that we won't have, we won't find it. What happened with that? Client is a client that's very successful. You'd probably do a higher one. If they don't have any reason to cook the books, they're doing very well. You may, when someone's doing well, you may say, okay, well, we're not going to audit it to as high a level. Maybe we'll do it at the 95% level. You know, because oh, yeah, make these match. So if a client is riskier, you audit to the lower detection risk. In other words, you get it down to 1% or whatever it is low, you know, because you got to look for stuff and you don't want anything slipping through. The client's doing very well. Unlikely they're going to cook the books. There's no reason for them to cook the books. You might bump that up a little bit. Okay, we will be, instead of being 1%, you know, except for a 1% detection risk, we'll accept a 5% detection risk. We'll add it to the 95% level, you know, 5% detection risk. Simply because it's much less likely. So the more risky a client is, the more work you got to do as an auditor. That's basically what it's saying. You know, if the client looks like they're having financial difficulties, there's more reason for them to cook the books, to get financing, and you know, all this other stuff. So those are clients that you have to really put in a lot more work, audit down to the 1% detection risk. Again, client that's not as risky, maybe you audit down to the 5%. You still do an audit, and you still do a, you know, appropriate net, but you might give them more of a leeway simply because it's less likely. Okay. These are just yeah, a little bit of cleaning up here. All right. So when it comes to internal controls, there is an audit report for internal controls by the PCAOB. So if you are doing the audit of their financial controls, and it's a publicly traded company, you also do an audit of their internal controls. To do an audit of internal controls, you must also do their financial audit. It's possible you do a financial audit and don't do the audit of internal controls. But if you're going to do the audit of internal controls, you have to do the financial audit. Partly because if you do find material misstatements, that might indicate problems in internal controls. Okay, so now the question is, so you have two different audits, and they're going to be going on simultaneously. How do you report on them? You can report on them separately. You give an opinion on each one, or you can combine them. In the past, most companies combined them, but now more companies do them separately. For years, you'd only see number ones. Oh, they're usually done by the same people. Good question. Yeah, so as you're going through a company, and this is another kind of odd thing that, so you have to do an audit if it's a publicly traded company. You must have an audit on internal controls. If you're not publicly traded, you can have an audit on internal controls, but it's not required. Most people don't. So if you are publicly traded, though, the same auditors must do the internal controls and the financial audit. it is kind of quirky that you could actually have a financial audit without doing the internal controls, but whoever comes in and does the audit of internal controls would have to do a second financial statement audit, which I can't imagine even paying for two financial audits. But to do the internal control audit, you must do the financial audit. Reason being, when you're doing the financial audit, it might highlight where there's problems that you have to look at for internal controls. So, a non-publicly traded company, you don't have to test internal controls. Publicly traded company, you have to test internal controls, not for the financial audit. For the financial audit, you don't need to test the internal controls, only if you're going to rely on them. But you must test the internal controls for doing the internal control audit. So the rules are still the same, as that you only need to do for the financial audit, you only have to test to if you're going to rely on the controls. However, because there's this internal audit for internal controls, it's not internal audit. There's an audit for internal controls. It's an external audit that but you must do testing for that. So for the external audit of the internal controls, you must also do the financial audit, and you must do testing of the controls too, but not for the financial audit, only for the internal control audit. Okay. So this is basically what goes on behind the scenes in companies. Management accepts responsibility. Management will evaluate the effectiveness of the internal controls. Notice they don't say efficiency. They say effectiveness, not efficiency. They might be inefficient as long as they work. Management must support its assertion. So management will say whether they think the internal controls are effective or not. And they must back it up with sufficient appropriate evidence. Okay, you're saying your control's working. How are you? What data are you using to prove that, basically? And they must apply a written assertion. Do I have it in here? Okay, I don't think I have it here. I should maybe. One of the things we do as auditors is we do a report on internal controls, and we also do a report. The reporting is on the management's assessment. So management assesses the internal control. We do an audit on that, on management's assessment of internal control. And if we find more controls that are weak, we include those that, these are weaknesses. If we, and at the same time, we'll be seeing if the evidence that they have, if it supports their controls, and if it doesn't, then that will be something we write up also. But internal controls are those things that are, to make sure that management that reasonable assurance about whether the reporting, in our case, the reporting is done accurately or accurately enough. Now, we do a report on management's assessment of internal controls. That is our internal control audit. Some of the external auditors, the internal control audit, that one will list weaknesses in internal controls. It only lists those things that are still uncorrected at year end, but you'll list those things that are internal control weaknesses in the audit on internal control weaknesses. And the idea is basically for publicly traded companies, big large companies, they're not going to be leaving the door open to the jewelry store. They're going to have some pretty serious controls in there, and if there is anything, it probably cannot be exploited by anyone outside the company. So those are included in the report. And a few things. This is indicators of weakness. You discover fraud. You have a bunch of restatements from the previous audit. You identify a material misstatement during the audit. if there is a material misstatement, it probably indicates that there's a weakness in the internal controls. And ineffective oversight and reporting of the controls. This is governance is basically is board of directors, and or audit committee. They'll often just lump those as governance. Oops. Okay. Any identified material weakness and significant deficiency should be communicated in writing by the release of the date of the audit report. So you're going to let the company know about these before you release the audit report. So the weaknesses must be reported before the report. For government entities only, written reports must occur within 60 days of it. Okay. Lesser deficiencies should be communicated in writing to management within 60 days of the release of the report date. It should be informed of those. Okay, so notice the difference, lesser deficiencies. If you're doing an internal control audit, all the deficiencies must be written. If it's a financial audit, it's written or oral. If it is an internal control audit, they must be written. Auditors are prohibited from saying that there are no internal control weaknesses. You cannot say that. You might have a client that wants you to say that. Well, can you just say that there's no material weaknesses in an internal control? No, you can't, because it's not that you know everything. You test to a certain level, 99% level, 95, whatever. There's going to be 1% or whatever that you don't know about. Furthermore, internal control is one of those things that changes. The ways that we combat fraud and all that kind of stuff. I'll tell you something funny. When I was growing up, Caitlin, you're going to be the winner. I'm going to give you extra points here. When I was growing up, the Social Security numbers were everywhere. They put your Social Security number on everything. They list our grades. When I went to college, our grades were listed by Social Security number. You look at it, they'd print the grades out on the sheet and put it outside the room, and you'd go down and find your Social Security number and go across to your grade. I was wondering, like, if someone found those, some fraudsters or whatever found those in the garbage or something, they used to do it for everything. I worked in a bicycle shop. We didn't do it, but there's another bicycle shop that one of the things they advertised was, we will stamp your Social Security number on your bicycle. That way, if someone steals your bicycle, you can prove that it's your bicycle because it has your Social Security number stamped on it. Nowadays, you go berserk not to have your Social Security number out there, but back in the day, that was what they did. It was on everything to prove that you own this bicycle. Okay, I'm not going to go too much into this. CASO. And the CASO it basically gets together a bunch of different people who all have their ideas on internal controls. So the American Accounting Association, that's kind of an academic accounting group. The ACCPA, which are fond of, financial executives, IMA, Institute of Internal Auditors. All these different groups have their own ideas of internal control. And so the idea was they'll all get together and we'll come up with one unified internal control statement. And they have been doing it, and this is tested on the CPA exam. It's a little bit confusing, but it's there's nothing, other than the way it's presented, there's nothing terribly confusing about it. Basically, you have these different control areas that you're going to look at. So the 5 different control areas here. And they basically just go into the different areas that they are associated with. Are they associated with operations, reporting, or compliance? And at what division? Is it at the, corporate division? Is that, or whatever division is that? So it's not terribly complex when you think about it. Basically, you have to know these 5 different areas. They could be any one of those in there. Some of the controls will have the same, will that be for all of them, and so on. So anyway, these are the control activities that they're going to have. And this is how they fit into the structure. And again, the idea was that we get all these people together and we come up with one unified idea of internal control. Because the AICPA is part of this, this gets tested on the CPA exam. And when you take the CPA exam, it's one of those things you memorize. Take it. Okay, well, next week, we will do the chapter 7. Wait, next week is the 15th. I'm going to change this. Next week, we'll start, we should start and finish chapter 16 or 17. We'll do 17. And I'm going to combine these 2 for the test. So our last exam will be chapter 7 and 17.
Is there a final, or is that last exam just the last test?
This will be the final. Yep. No, we're not. It's not going to be a comprehensive final. This will be. I'll do 7 and 17. That'll be our last test.
Okay.
And yeah, I mean, that way we also have one more test to do. So chapter 17 is on reporting. We've already done a little bit of that already, but we'll go through a little bit more of it. And then chapter 7 and 17. Any questions? I'll take that as a no. Okay, well, go and enjoy the beautiful day we have.
Thank you, you too.
Okay, already got it in. Okay, thanks.